Last time we discussed about material costing and we went through the three valuation techniques, which is LIFO, FIFO and FCO. Okay, and we understood that what is the difference between the valuation of these three methods. Now what do we have next in material costing? Hold on. Okay, sometimes students ask me that whether we have only these three systems or valuation techniques to value the inventory. Well, not really. We do have other techniques also, but these three are the most renowned ones among the accountants. And if we relate the inventory valuation techniques with what is allowed in international accounting standards, then we are allowed only FIFO and average value of costing methods, not any other methods. Okay, so that's why we study FIFO, LIFO and FCO. LIFO is strictly prohibited under international accounting standards, but we still study it because in few countries accountants are still following this method. Okay, let's continue with our lecture on material costing and understand that. Let's compare the valuation techniques with each other, and let's see how selection of different techniques can affect the different aspects of your financial statements. Like one of the important one is profit. Okay, and if we look at how you calculate your profit, it is like sales less cost of sales, and then you get gross profit. Now if you remember, or let's just discuss one thing first, that if you see this formula or this statement, you can see that if your cost of sale is going to reduce and your sales remains constant, your profit will be increasing. But keeping the cost of sales constant and increasing the sales will also increase your profit. But going deeper in this and looking at the formula of cost of sales, we have opening stock plus purchases minus closing stock. Now if the valuation of stock, especially the closing stock, is increasing, your cost of sale will decrease because more and more will be deducted from the sum of opening stock and purchases. So anything that is pushing the value of closing stock up, whether you have more units of closing stock with you or just because of the valuation technique you followed, the value of closing stock has increased, it will have a direct effect on gross profit. The higher the value of closing stock is, the higher your profits are going to be. If value of closing stock goes up, then your profits will also increase. And similarly, if the value of closing stock decreases, then profits will also fall. Okay, now that means there is a direct relationship between the closing stock and the profits. Let's understand that with one easy example. Let's say you have the opening stock, which is 100, and then the value of purchase is 5,100, and the closing stock you have with you is 800. So if you just sum this all up, the value you get is 5,200 minus 800 gives you 4,400. Okay, and this is your cost of sales. Okay, and let's suppose even further that your sales are 8,000, right? And deducting cost of sales out of sales will give you your profit, isn't it? and in this case your profit is 3,600, right? Now suppose the value of closing stock reduces for any reason. It can be because you counted the stock and you found that lesser number of stock is present with you in the godown, or you have changed the valuation technique, okay, and because of that the value of closing stock is no more 800, it's less than that. So let's see how is it going to affect our calculations of profit. All the other things are same, opening stock and purchase is still the same, but the value has reduced to 650 instead of 800 for closing stock. In this case, your cost of sales will increase by 150. I mean, there will be a corresponding increase of cost of sales. 150 value has, there is a decrease of 150 in closing stock, and because of this, your cost of sales is going to jump up by 150. So it will be 550, your new cost of sales. Okay, and if you deduct it now from same $8,000 of sales, we deduct cost of sales, that's why it is in brackets. So it will be, so now you can see that the value of your profit has reduced by 150, which is 3,450. Clear? So that's what I'm saying, that there is a direct relation with the valuation of stock and profits of the business. So now, understanding this, that increase or decrease in the value of stock hits directly the amount of profits in your business, let's understand that how your valuation techniques can affect the value of your profits. You know, FIFO, we understand that it's first in, first out. That means the older the stock is will be the first one to leave the godown towards production hall. Whereas in case of LIFO, which is last in, first out, it is the latest stock that you have with you will be leaving for production. Okay. Now, let's understand one thing. We have different kinds of economies going on around the world, but most of the time it is inflationary. That means the prices are going up. It's kind of a false statement, but still, let's take it what they tell you about inflation. That is, that inflation is that every now and then your prices are going up. So over a course of period, or a period of 1 year or 1 month, your prices will be increasing gradually. So what happens is, the goods that you have bought at the beginning of the period will not be costing as much comparing to the goods that you have bought almost at the end of the period. Okay. Now listen very carefully. In case of FIFO, let's take an example. For example, this is your buying pattern. For June 1, you bought 100 units at 60. At June 10, you bought 200 units at 70. For June 20, you bought 300 units at 80. And on June 30, you bought 400 units at 90. Okay, so just an assumption. Your rate is increasing. as the time is passing, as you are progressing through the time, your rate is also increasing. Now if you are following a FIFO method, and by June 30th you have to issue, let's say, 800 units, alright, you will be following this pattern. You will be going from the very first one and then applying the units that you have bought later. Okay, so let's see. Under FIFO method, the first one leaving for production hall will be the 100 units, which we have bought for 60, so it will be costing you 6,000. Then 200 units for 70, which is 14,000. Then 300 units for 80, which is 16,000. And now you have to issue 200 more for, then this will be for 90, and this is 18,000. Now this is the value of the stock that you have issued for production hall. Yes, 24,000, sorry. Okay, and if you sum this up, this is your cost of the goods that you have issued, or in other words, cost of sales. Okay, so sum this up please. 6 plus 14, 20, 20, 44, 44 plus 18, 62,000. Now at the moment I'm not interested in this value. What I'm interested in is I will be left with only 200 units, right? And this 200 units, it will be valued at 90. And according to FIFO method, the value of closing stock will be 18,000, right? Now let's see, if you were following LIFO method, what would have been the case in that situation? It would be like 160, sorry, we'll be starting from bottom up, right? Whatever came in latest will be issued to production hall at first place. So 400 units at 90, it will be 36,000, and then 200 units more for 80, which is 16,000, right? So if you just sum this up, it will be 52,000. No, sorry, we should just only 600 so far. Issue more, 200. So it will be 100, sorry, 300 from this, it will be 24,000. And you need 100 more, which will be issuing from 70, which is 7,000. Okay, now sum this up please. It will be how much? 67,000, right? Now moving on to the closing stock that you have, it will be 100 units according to 70, which is 7,000, and 100 units according to 60, which is 6,000. And if you sum this up, the value of this will be 13,000. Now we understand that under an inflationary economy, as the most expensive unit has already been consumed in the production hall, your cost of sales will be more if you are following LIFO method under inflationary economy. And also, your closing stock value will be less. And because of that, your profit will also be less. But in the same economy, for the same situation, if you are following the FIFO method, the less expensive units will be issued to production hall, so your cost of sales will be less. And your value of closing stock will be more because it will be based on latest higher prices. And higher closing stock means higher profits. So now we understand that valuation has its effects on the profits also. That is why this is what organizations were doing. If they want higher profits, they were using the one that gives them higher profits. And if they want lower profits, they can use the method which is going to give them lower profits. Okay, so we had the option to fiddle with the figures. But we ruled out LIFO. And the reason why we did it, well, that's not actually part of our syllabus, but still, what we wanted to do is, like, why LIFO is not permitted under International Accounting Standard. I will come to that in a minute, but tell me if we are clear on this part. Have we understood that how FIFO and LIFO can affect the valuation of profit? Okay, good. Now let's understand why LIFO is not permissible. In International Accounting Standard, we focus more on the balance sheet. I mean, the figures you have in the balance sheets are more important than the figures we have in the income statement. Because whatever is in the balance sheet will be carried forward to the next period, but what is in the income statement, it stays there. Okay, it's history. So we tend to have more accurate figures. We want more accuracy in the figures that are in the balance sheet, because if it is not representative of the latest state of the business, or if we are following such policies that is not in accordance with the latest circumstances, then the whole purpose of having a balance sheet, it misses out. Okay, it just blurs out. We don't want that. You know, when you are valuing your closing stock, that means the stock which you have just now at the end of the year, but the valuation basis you are using, you see that, is like for the beginning of the year, it doesn't make any sense. If you have the stock with you just now, you should be using the prices that are ruling currently. That means you should be using current prices instead of old prices. That's why International Accounting Standard recommends using FIFO method, because if you follow that, you will be valuing your stock on latest price basis. Okay, that is the reason. Otherwise, International Accounting Standard don't want your profits to be more. It's not the purpose behind it. The real purpose is that your valuation of stock will be based on latest prices instead of old and outdated prices.